The Fed is currently lying about the economy, and doing so will only make the coming crash worse. Today I want to talk about whether lower inflation means the stock market crash is over, and what this means for the AMC squeeze. So stay tuned, and let's make some money. And now I want to dive straight in with the key information. So, Quote the Raven posted this article saying lying about the economy will only make the coming crash worse. They said, I really don't know how to describe the disturbing trend over the last few months of the Biden administration, along with Treasury Secretary Janet Yellen simply lying to American people about the economy. Months worth of political spin has culminated in embarrassing recent attempts to redefine the word recession, a futile attempt to pull the wool over our eyes. The inflation print today showed a fall from the past 9.1% down past the expected 8.7% all the way to 8.5%. Now, a large reason for this drop in inflation is a result of reducing gas and energy prices. However, many prices across the board, such as rental costs and food costs, have absolutely increased. A reduction in inflation to 8.5% does not mean the stock market crash is over, as 8.5% is still the second highest inflation print in the last 40 years. They said by now the administration's pathetic falsehood of narrative about our economy has been called out, ridiculed, dismantled, and generally beaten to death by anyone with a shred of common sense. They said, however, there is something far more important that people aren't talking about. The administration lying about the health of the economy that could wind up exacerbating any financial crisis we have in the near future. They said the first shock will come in the form of the rate hikes that have already happened over the last few months. It says the Fed has hiked rates so quickly, the economy with its record amount of outstanding debt still has yet to catch up. Over the next quarter or two, we're going to see the real effects of 2% worth of recent rate hikes play out in the economy. And as Zero Hedge points out, these rate hikes are coming at the worst possible time, at a time that personal savings rates have collapsed to 5.1%. That means that on average, only 5.1% of American pay from each paycheck is being saved. Compared to previous highs in 2020, this was around, at its highest, nearly 35%. This is the lowest savings rate seen since August 2008, at a time when rates are increasing, rent is still increasing, and food prices are still going up. And they said it's this delayed reaction that, in my opinion, is going to cause a repeat of the December 2018 market sell-off. And the second shock that people could be in for is if the Fed decides to hold its nerve and doesn't begin to discuss a pivot. The Fed is still very hawkish and it's been saying we are committed to bringing inflation down and we are going to do what we need to do. Inflation has decreased from 9.1% down to 8.5%, but it seems the Fed is going to do absolutely everything they can and anything they can, regardless of the consequences, to continue getting this inflation down from 8.5% back to 2%. Therefore, the Fed may continue raising rates at 75 basis points at every single FOMC meeting until inflation finally touches that 2% mark. But that may mean that rates rise to 3%, 4%, or even 5% until inflation is back at that 2% area. Raising rates to 5% would over double the current rate, certainly crashing the US economy. And he said, but most importantly, the Biden administration reassuring the American public that everything is fine economically, when it isn't, is only going to make matters worse. The American public will be that much more surprised when they can no longer afford to service their debt when they've been told the economy is absolutely fine. They'll be more surprised when there's no stimulus checks on the horizon, but the American public can't afford rent and can't afford food. They'll be more surprised when the market starts to crash as a result of this 2% at the moment rate hike, and they'll be even more surprised when everybody starts to capitulate and the market bottoms out. Over the last few weeks, I've spoken about many different layoffs across the tech sector, not just in crypto, not just in startups, but across tech as a whole. But you may say, Tom, are we seeing layoffs across other sectors, not just tech? And guys, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 10 free stocks worth up to a whopping total of $25,000. Moomoo is very easy to use, it's incredibly customizable, they've got tons of technical indicators and advanced charting tools. From Moomoo's latest customer agreement, they officially state they do not sell your order flow. Therefore, Moomoo is brilliant for buying those AMC and GameStop shares. Well, last week Walmart announced their first round of corporate layoffs after slashing their coming forecast as well. Walmart's most recent earnings weren't great and the stock fell quite harshly. As a result, Walmart confirmed on Wednesday that it's begun laying off corporate employees already. Walmart has also slashed its profit outlook for the next quarter and is looking to cut costs by laying off employees. And they've also warned that consumers have pulled back on their discretionary spending as a result of inflation. So not only is rent still increasing, food bills are also increasing as well. Yes, technically gas and electricity is reducing slightly, but as a result, the American public doesn't have as much money, their savings rate is decreasing, and discretionary spending is also falling as well. And again, Business Insider is also reporting that shoppers are actually flocking to dollar stores for canned goods because they can no longer afford fresh food as a result of soaring inflation. Now, yes, inflation did fall over the last month, but if we look at this inflation breakdown, while the majority of this fall was a result of these falling energy prices, a number of prices across the board, namely in food and shelter, are actually still increasing. This is why shoppers and general Americans can no longer afford food while their savings rates are decreasing, and why they no longer can spend as much on discretionary items. Now, this has led to the US Senate passing a $740 billion Inflation Reduction Act. And Crypto World tweeted saying politicians are really out here trying to convince the public that printing another $740 billion will decrease inflation. It seems the Fed and individual states are doing practically anything they can to convince Americans that everything is fine by providing inflation relief stimulus checks and even Inflation Reduction Act spending. Now, Zero Hedge tweeted a little while ago saying the Atlanta Fed Q3 GDP estimates have been slashed to just 1.3% from 2.1% on Friday. Obviously, if we have a third quarter of negative GDP growth, that means 3 consecutive quarters of GDP shrinkage or negative GDP growth, which is again just another sign of recession. It seems the US is still in a recession, spending is still low, saving is still low as well, and this recession ultimately will culminate in a stock market crash. And this is also leading to a $1 trillion reverse repo headache for these major US banks. This Reuters article says the trillions of dollars in overnight cash tucked away daily at the Federal Reserve could turn into a major headache for banks that could squeeze their balance sheets and impact their ability to lend. Now, obviously, if lending is damaged during the current recession, this will almost certainly end in a stock market crash. This is the Fed's reverse repo facility, RRP, has attracted a wide array of market participants, helping to mop up excess liquidity in the financial system. This is the Fed is paying a record reverse repo rate of 2.3%, just showing how desperate the Fed is to mop up this excess liquidity. It says investors are effectively taking deposits away from banks and taking cash out of the stock market and putting them into government money market funds, which invest mainly in treasuries and repos. It says repo allocations from government money market funds have increased to nearly 40% of their assets currently, from around only 30% beforehand. That means investors are selling their stocks, taking cash from banks, investing into these money market funds, which dump their money into reverse repos. But again, this just means the banks don't have as much cash, they don't have as much cash invested into the stock market, and all of this cash is instead being given to the Fed in this overnight repo facility. These banks therefore won't have cash to lend out, and they're only going to be receiving this 2.3% interest rate offered by the Fed. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.